In Q1 2026, the largest capital allocators on the planet began moving in the same direction simultaneously, not in a panic and not in a frenzy, quietly, systematically, through regulatory filings and portfolio disclosures. Warren Buffett built a total cash position of approximately $373 billion in United States Treasury bills and cash equivalents. 43% of the world's central banks simultaneously increased their gold reserves. The energy sector became the best performing sector in the entire S&P 500, with ExxonMobil up 48% over 12 months and Chevron returning 21.8%. And while all of this was happening, the same investors were systematically exiting technology stocks, reducing exposure to overvalued growth names, and walking away from private credit funds that had locked their capital behind withdrawal gates. This is documented in filings confirmed by portfolio disclosures and verifiable in public data. The three assets being bought, gold, short-term treasury bills, and energy, share one defining characteristic. They all perform specifically in the environment that the data of early 2026 describes. The first asset is gold, not as speculation and not as a doomsday hedge, as a core portfolio holding that the largest sovereign institutions in the world are actively expanding at a pace not seen in modern financial history. Gold reached successive all-time highs in late 2025 and early 2026, trading above $3,000 per ounce. The price movement is not the story. The story is who is buying, at what scale, and why. According to World Gold Council survey data, 43% of the world's central banks are actively increasing their gold reserves, not considering it, not discussing it, actively acquiring physical gold. Central banks purchased 1,082 tons of gold in 2022, 1,037 tons in 2023, and 1,045 tons in 2024. Those are the three highest annual purchase totals ever recorded. More than 40 central banks are participating. This is not one or two countries making a speculative bet. This is a globally distributed structural shift in how sovereign institutions view the role of gold in their reserve portfolios. The documented reason is straightforward. In 2022, the United States and its allies froze approximately $300 billion in Russian foreign exchange reserves as a geopolitical sanction. That act sent a direct message to every central bank on Earth. Your dollar reserves can be frozen with a phone call. Gold cannot be frozen. Gold cannot be sanctioned. Gold exists outside the system that any government controls. Central banks have responded accordingly. China has been systematically converting US Treasury holdings into physical gold. Poland announced a target of 20% gold in its national reserves, a commitment that requires continuous purchasing regardless of price. India, Turkey, and virtually every major emerging market central bank has accelerated acquisition. This creates a structural dynamic that did not exist in prior gold bull markets. In previous cycles, central banks were net sellers of gold, acting as a price headwind. They are now the most consistent marginal buyers, with explicit multi-year allocation targets that require purchasing regardless of market conditions. Deep price corrections become buying opportunities for sovereign institutions, not selling triggers. Morgan Stanley's chief investment officer publicly endorsed a 60-20-20 portfolio model, 60% stocks, 20% bonds, 20% gold. That is a significant departure from the traditional 60-40 allocation that has dominated institutional investing for decades. JP Morgan published a gold price target of $6,300 per ounce by end of 2026, with an upside scenario modeling $8,000 to $8,500 if household allocations to gold rise from approximately 3% to 4.6% of assets. Goldman Sachs, Deutsche Bank, and Bank of America have all published structurally bullish gold forecasts for 2026. When every major Wall Street institution and 43% of the world's central banks are buying the same asset simultaneously, the signal is not ambiguous. Basel III banking regulations, implemented in 2023, now recognize gold as a Tier 1 high-quality liquid asset. Holding gold now satisfies capital adequacy requirements in ways it previously did not. Global gold ETF assets under management now exceed $200 billion, providing institutional scale liquidity that was not practically available a decade ago. The Sprott Physical Silver Trust raised approximately $1 billion as silver surged significantly in 2025, confirming that the hard asset allocation shift extends beyond gold. The structural case for gold is anchored in government debt mathematics. The national debt is approaching $37 trillion and growing at an estimated $7 billion per day. Interest payments on that debt now exceed $1 trillion per year. The Congressional Budget Office projects those interest payments will reach $2.1 trillion by 2036. Federal Reserve Chairman Jerome Powell, speaking at Harvard University on March 30, 2026, stated in plain terms that the current fiscal trajectory will not end well. When the chair of the institution that controls the money supply publicly states the fiscal path is unsustainable, gold's behavior is not speculative. It is a documented response to confirmed currency debasement. The second asset is the one Warren Buffett has bet $373 billion on. It is also the simplest instrument in all of finance. Short-term United States Treasury bills, parked in the safest, most liquid sovereign instrument ever created, currently earning approximately 3.6% annually with zero principal risk. Berkshire Hathaway's 10K filing confirms $314 billion in Treasury bills specifically. That is more than the Federal Reserve itself holds in the same instruments. Buffett sold a net $172 billion in equities across 12 consecutive quarters. He reduced Berkshire's position in Apple, and one of the greatest businesses in the world, by more than half. He trimmed Bank of America and exited multiple positions entirely. He took all of that capital into Treasury bills. The result is documented. While the S&P 500 has fallen approximately 11% year-to-date in 2026, Berkshire Hathaway stock is up approximately 12% over the same period, a 23 percentage point spread in performance while taking essentially zero market risk. That cash position generates approximately $13 billion per year in completely risk-free interest, $13 billion annually, while the investors who were fully allocated to technology stocks and growth names are watching their portfolios shrink. Cash is not a passive position in this environment. It is an active one, providing two things no other asset delivers simultaneously: income and optionality. You receive income while you wait, and when prices fall to levels representing genuine value, which Buffett's actions clearly signal he expects, you have the ability to deploy capital at precisely the moment when everyone else is being forced to sell. During the 2008 financial crisis, Buffett deployed cash into Goldman Sachs and General Electric on terms unavailable to any other buyer. He could do that because he had the cash. The fully allocated investor had nothing to deploy and could only watch their portfolio decline. Greg Abel, Berkshire's vice chairman and named successor, initiated the first Berkshire share buyback in nearly 2 years during the current correction, confirming that Berkshire leadership views this environment as one requiring defensive positioning with selective opportunism. Buffett is not alone in this position. Bank of America's Global Fund Manager survey confirmed that institutional cash allocations jumped from 3.2% in January to 4.3% by March 2026, the fastest institutional shift to cash since the COVID-19 pandemic. Growth optimism among those managers collapsed from approximately 40% in January to just 7% by March. Inflation fears surged from 9% to 45% in the same period. When the people who manage trillions of dollars are simultaneously moving to cash at pandemic-era speed, they are doing it because the risk-reward calculation in equities has inverted. The potential downside now exceeds the potential upside by a margin that makes full investment irrational at current valuations. There is also a structural advantage to Treasury bills that distinguishes them from other cash instruments. A bank deposit is an unsecured loan to the bank. A money market fund is a pooled vehicle holding various short-term instruments. A Treasury bill, held directly, is an obligation of the U.S. sovereign issuer with no intermediary and no counterparty risk from any bank. In a systemic banking stress scenario, Treasury bills held directly are outside the blast radius. They cannot be bailed in and cannot be frozen by a bank regulator. Berkshire held $144 billion in Treasury bills even through the near-zero rate environment of 2021. It was never solely about the yield. It was always about the positioning. The ability to survive any crisis without being forced to sell, and to deploy capital when the best opportunities appear. At 3.6%, the yield is now a genuine bonus on top of that structural advantage. The third asset is one that most retail investors abandoned years ago on the assumption that the future belonged entirely to technology and the digital economy. Energy, specifically the integrated oil and gas companies that produce the physical commodity the entire global economy runs on. As of the end of Q1 2026, the energy sector is the best performing sector in the S&P 500, up more than 22% year-to-date. ExxonMobil is up 48% over the past 12 months and 26% since January 1st. Chevron has returned 21.8%. The SPDR Oil and Gas Exploration and Production ETF is up nearly 30% year-to-date. The conflict involving the United States, Israel, and Iran that began February 28, 2026, and the brief partial closure of the Strait of Hormuz sent Brent crude briefly above $119 per barrel. But the investment case for energy is not only about the current conflict, it is structural. The major oil companies now operate under what industry analysts call the capital discipline era. Instead of chasing production volume, they are focused on generating cash value, returning record amounts to shareholders through dividends and buybacks while maintaining production discipline even at elevated prices. ExxonMobil's break-even cost is approximately $40 per barrel. At $80 per barrel, they are generating substantial free cash flow. At $100 per barrel, they generate cash at a pace that allows simultaneous dividend increases, share buybacks, and investment in new production. Their operations in the Permian Basin and offshore Guyana, now producing over 900,000 barrels per day, provide a low-cost production base structurally insulated from Middle East disruption. Morningstar's February 2026 analysis documented the institutional rotation precisely. Industrial, consumer defensive, and energy stocks are outperforming the broader market by a wide margin, offsetting losses in technology, communication services, and consumer cyclicals. The phrase being used on institutional trading desks is bits to atoms. The market is rotating from digital speculative assets to physical producers of essential goods. The dividends confirm the investment case independent of price appreciation. Chevron currently yields over 3%. ExxonMobil has maintained and grown its dividend for over 40 consecutive years, qualifying as a dividend aristocrat. Enterprise Products Partners, one of the largest midstream pipeline operators, has raised its distribution annually for decades. In a market where the S&P 500 is down, an energy stock up 26% paying a 3% dividend represents a total return more than 30 percentage points ahead of the average portfolio. Not a marginal difference, but a generational divergence in outcomes. There is also a structural demand argument with nothing to do with geopolitics. The explosion of artificial intelligence and data center construction has created enormous new demand for reliable 24-hour power generation that solar and wind cannot currently provide at scale. Natural gas, which ExxonMobil and Chevron produce in large quantities, is increasingly the essential bridge fuel for the AI revolution. The technology sector that was supposed to make energy companies obsolete has instead created the largest new source of energy demand in decades. Saudi Aramco's CEO stated in March 2026 that the current Middle East conflict represents the biggest crisis the region's oil and gas industry has ever faced, underscoring that supply constraints are converging with this entirely new demand source simultaneously. Where institutional investors are moving from is as important as where they are moving to. They are leaving technology stocks. The Nasdaq has underperformed the broader market in 2026. Several of the Magnificent Seven stocks that drove the majority of S&P 500 returns over the past 3 years topped in late 2025 and are now 15% or more below their all-time highs. The S&P 500's forward price-to-earnings ratio stood at 22.2 at the start of 2026, well above the 10-year average of 18.8. The Shiller cyclically adjusted PE ratio has been at its second highest level in over a century of data, exceeded only by the year 2000 at the peak of the dot-com bubble. Institutional investors are not selling technology because they believe it has no value. They are selling because it is overpriced in a decelerating economy with sticky inflation and elevated interest rates, conditions that produce sustained downward repricing pressure. They are leaving private credit. BlackRock blocked nearly half of all withdrawal requests from its $26 billion HPS lending private credit fund in March 2026, as confirmed by Bloomberg. Blackstone, Cliffwater, Morgan Stanley, and KKR have all faced significant redemption pressure simultaneously. $265 billion in private credit assets are either gated or facing withdrawal demands, according to Fortune. These are not bank deposits and not FDIC insured. They are investment vehicles where capital can be legally locked behind a withdrawal gate with no federal backstop. Payment-in-kind loans, where borrowers add unpaid interest to the principal rather than paying cash, reached 8% of the total private credit market by 2025. That is the accounting signature of a sector masking its own deterioration. Institutional investors have seen the data and are heading for the exits. They are leaving long-duration bonds. The Bloomberg Aggregate Bond Index posted its worst year in history in 2022, down 13%. Those losses have not been fully recovered. The conditions that created them, elevated inflation, high interest rates, and massive government borrowing, have not materially changed. The Federal Reserve held rates at 3.75% at its March meeting, with the next FOMC decision on April 28 to 29. United States bank securities portfolios are sitting on hundreds of billions of dollars in unrealized losses, the direct consequence of rates rising faster and staying higher than the coupons on bonds purchased during the zero-rate era. The Fed is paralyzed. Cutting rates would re-accelerate inflation, while holding rates continues to suppress growth already running at 0.7% GDP. Long-duration bonds are the asset class most directly damaged by this paralysis. The convergence of what elite investors are buying and what they are selling reveals one unified thesis about the direction of the global economy in 2026. Physical assets will outperform financial assets. Income and cash flow will outperform speculative growth. Capital preservation will outperform capital appreciation in the current environment. The conditions supporting this thesis are not speculative. They are documented and concurrent. Consumer sentiment at 53.3, GDP growth at 0.7%, inflation expectations at 4.2% per OECD. National debt approaching $37 trillion, growing at approximately $7 billion per day. An active Middle East conflict disrupting the world's most important oil transit route. A Federal Reserve chair publicly warning the fiscal trajectory is unsustainable. And a stock market where the Shiller Cape sits at its second highest reading in over a century of data. 3 major financial era transitions in modern history confirm the pattern. The rotation from growth to value happened in 2000. The rotation from real estate to cash happened in 2007. The rotation from financial engineering to fundamental quality happened in 2022. In every case, the investors who recognized the shift before it was consensus and positioned accordingly compounded their advantage throughout the transition. In every case, the investors who held the assets of the previous era, hoping conditions would return, absorbed losses that took years to recover from. The signals in 2026 are not merely visible. They are documented in the actions of the largest, most sophisticated capital allocators on the planet. 43% of central banks buying gold, Berkshire Hathaway holding $373 billion in cash and treasury bills. The entire institutional energy rotation confirmed by sector performance data. Morgan Stanley's CIO endorsing a 60-20-20 allocation model. JP Morgan publishing a $6,300 gold target. BlackRock gating withdrawals from a $26 billion private credit fund. These are not anonymous predictions. These are the documented positions of institutions that manage trillions of dollars. Gold provides institutional insurance against currency debasement and geopolitical instability. Treasury bills provide income without risk and optionality to deploy at maximum distress. Energy provides exposure to the physical economy, reliable dividends, and structural demand that is growing, not shrinking. All 3 of those conditions are simultaneously present in the global economy of Q1 2026. That is why the largest capital allocators in the world are not debating which of these 3 assets to own. They are buying all 3.